Welcome back to Be Rich. And today Sashwath is here with me to discuss the problems in the bond market, especially in America. And this holds true here also. And people ask me that they can go to sites like Golden Pie and buy whatever bonds they want. Or there's another site which is there in which you can buy bonds whatever they want. And they assume that there are no risks in buying a bond. So, and this topic came up because there was an article in the Financial Times which Sashwath brought to my attention by Katie Martin, in which the lady says that the difference between top rated corporates and the government bonds has vanished. And therefore, people are now piling on to any bond which is slightly above the government yields. Because in America, the 10-year Fed itself is giving 4.2.
Yeah, the yield spread has vanished.
The yield spread has vanished because somebody like Apple is also getting it at same price. And what has happened is that large amount of corporates have trying to borrow in the open market. In America, unlike in India, if a large corporate wants money, it cannot go to a bank, it has to borrow from the market.
And it has to pay a premium for that.
It has to pay a small premium for that. But that premium is the spread, and that spread has vanished. Whether the vanishing of that spread is justified or not is what Katie Martin is talking about. And I will allow Sashwath to explain, and then I will tell you about my Indian experience.
So with bonds, what we see is that the yield is something which a lot of people don't understand very well, which is because it's not extremely evident as to what the yield should be. It's more of the market deciding at different stages what the perfect yield would be in that point. So what ends up happening is that we see very different phenomenons. For example, we saw the inverted yield curve for the longest of time. And then we saw almost close to 0% yields on short-term treasuries in the US before that. So we basically have a scenario where yield spreads, that is the difference in yield between a riskier bond versus a safer bond has vanished. There is no difference in yield because the idea that a riskier bond should pay more is that because you're taking on that risk as an investor, you should be compensated for taking on that risk. Like how if you give insurance, you get a premium for it. In the very same way, for taking on a certain level of risk, you're paid a little bit more than what you would be if you lent risk-free. So generally, US treasuries are considered the risk-free bond because the government can at any point print more, because at this point, you can't let the government collapse. So most people consider the US treasuries to be the last stop in terms of safety. So on top of the US treasury, which is the risk-free rate of return, you have tiers of bonds. So you have, after that, you have municipal bonds, after which you have high-rated corporate bonds, after which you have medium-rated corporate bonds, and then you have junk bonds. They're called junk bonds, which yield you very high amounts of money. So today, what we see in America is that junk yields have come down, so have corporate yields come down, and you basically see no arbitrage to be made between US treasuries in terms of the yield versus corporate bonds or junk bonds. This basically signifies that people are piling on cash, regardless of what the yield is, in any form of asset which gives them a little bit more than what risk-free assets are giving. And the Federal Reserve has kept its interest rate up, which is why US treasuries are yielding what they're yielding. And this is basically a phenomenon which is sort of novel for US citizens after a long time. Because the last time we saw yield spreads get wiped out this way was when there was excess cash in the market with few assets and a lot of money to chase those few assets. So this is a unique phenomenon, and there doesn't seem to be much in way of disruptions in terms of risk in the bond market. The New York bond index, which basically tells you how healthy the bonds are, has dropped to an all-time low, which basically means that the bond market seems to be very resilient. So there seems to be nothing in way of risk as such, according to traditional indicators. And what Katie Martin says is that instead of focusing on yield spreads, what we should be focusing is on the fact that the bond market is very juicy right now, in the sense that interest rates are above their long-term average for the past decade or so. So this is pretty much what Katie Martin talks about in her commentary.
No, but what she is trying to say is, since the Fed itself has moved its rate up, and because the Fed rates has moved up, the corporate bond market rates also should have gone up.
But they haven't.
They haven't. So what the market, in my opinion, thinks is that this Fed rate for remaining so high is a temporary short-term phenomena, which which will become normal very sooner than later. And when it becomes normal sooner than later, if you have bought at a very high rate today, suppose you bought Apple at 5.5, or even you bought it at 5, the short-term rate will drop to 3, and still you have your 2% spread. So the market does not believe that the Fed can keep the rates as high as it has for this period of time. And that is why the rates are the spread is so low. If the market were convinced that the Fed is going to keep it at 5.5 for the next 3 years, you will find the premium coming back on.
But my question is, wouldn't they have moved their money from corporate bonds to treasuries? Because treasuries they see as artificially being propped up because of interest rates being kept beyond.
Yeah, but there are people like Buffett who have got more than 100 billions in short-term treasury.
Right. So shouldn't the short-term treasury yield come down because of market pressure?
No, it will not, because you already have China, India, and other countries selling those bonds. You know for sure that China, Russia, and Turkey are selling
to keep their currency afloat.
Selling and buying gold.
Yeah.
So the demand for treasury has been extreme from the American market. The distortion is because America is still spending money as if it's in a crisis. America fiscal policy and monetary policy are moving in opposite directions. The government is spending recklessly and borrowing recklessly as if there is no tomorrow. The fiscal deficit in US is 5 or 6%. I last checked, I don't know the current figure, but it is an extremely high figure.
But aren't they funding a war for democracy?
I'm not saying all that.
Yeah.
There is a crazy amount of debt being piled on to. So that is, the US government is hungry for money, and so there is demand.
So then how is the market expectation, which basically says that interest rates will come down later?
They feel that this inflation is a temporary phenomena, because Jerome Powell has always been saying that this is transient, and then left it too late to raise rates.
But if fiscal pressure is continuously propping up...
Yes. So, I also read in the same Financial Times a report where people are buying less food.
Okay.
That is, you can feel the inflation in grocery shops.
Mm-hmm.
So, there is inflation is hurting the middle class and the lower middle class. So, I don't think the Fed will be able to cut rates as quickly as the market expects it to cut rates, because the American economy has been very strong and the balance sheet is expanding because Fed has reduced the rate at which it is running down its balance sheet.
Let me get one thing straight. If they cut down rates today, isn't that giving their government a free check to spend how much ever they want?
Yeah, so they won't be able to, because the check is in inflation.
Yes.
So the prices of inflation.
Because if they cut rates today to say 2% or whatever the number is, 3%, then the arbitrage will be crazy where people will...
Yes, so what will happen if the Fed cuts rates today too earlier, then inflation will not come down.
Purely because the government is spending and borrowing.
Yes, exactly.
Yeah.
So the government needs to shore up revenue.
Yes.
But the Republicans and the Democrats cannot agree on how they can raise taxes.
Mm-hmm.
So the entire world is going to go through a rate of high interest rates. Even if the interest rates fall, it's not going to go back all the way zero.
Yeah, that's
so like Howard Marks said, from 0 to 2 and 2 to 4 are the places. He says it will be between 2 to 4. Long-term rates are going to be between 2 to 4. But I don't think the 4 will get reached by the time next year is over. We are between 5.25 and 5.5. To reach 4, you have to cut 1.25 to 1.5%. That is really 5 to 6 cuts. I don't think next year Fed will be in a position to cut 5 or 6 unless the American economy suddenly collapses. If American economy collapses, earnings of corporates should be under stress.
Aggregate demand is basically consumption plus investment plus government expenditure and net exports.
Net exports.
America is a net importing country.
America is a net importing country.
Yeah.
But it exports a lot of technology.
Right.
Whether I don't know whether it is properly accounted or not.
So let's keep exports aside. So you have C plus I plus G. Consumption and investment and government expenditure. The inflation we're seeing is because the
government is spending.
Yes.
And consumption because government gave money directly into the pockets of the poor.
That was a couple of years ago now.
Yes, but that is what has started driving this inflation.
Right.
And also, there have been so much hard talk of immigration that the labor is fully employed. Those who want to work are already working.
For Powell to see any the ticker move on inflation, so you're saying that if G won't budge, that is, government expenditure is not going to budge, then consumption has to come down.
Consumption has to come down. And another thing, I don't know how far he will cut rates before it reaches 2.
Because the dollar is doing quite well.
Yes.
So investment is not going to come down anytime
soon. And inflation, they are not going to have a cost push inflation.
Yeah.
They are going to have a cost push deflation, not inflation. Because as the dollar gets stronger,
yes,
imports are going to get cheaper and cheaper.
Because they're a net importing country.
They are net importing country. There is absolutely no. This is exactly why the market is wrong, in my opinion.
This feels like Reagan's imperial circle
exactly.
Again. You have an expanding balance sheet because the government is spending more and more and more. You have a country which is net imports, but its currency is strengthening.
Yes.
As time goes on.
Yes.
So how is this going to end then?
It'll end if the consumption, like that Reagan ended in a recession, the consumption has to drop. People have to be out of jobs. There has to be pain. Everybody expected it last year. It didn't happen. They expected it this year. It didn't happen. But it will happen. Because in Canada, you can see the pain already.
But he's talking about a soft landing where you basically don't have...
The soft landing is a misnomer. The amount of money printed is so huge, from 900 billion to 9 trillion in 10 years. And you're not reducing money supply. At the first sign of trouble, the Fed was running down at $600 billion per month. Now they have said they will reduce it.
Okay.
So if they reduce this, if they continue to sell markets at the market bonds at the rate at which they were running it down, then rates would have been not at 7, would have been 8, 9, and real estate prices would have dropped. But the Fed does not want real estate prices to drop, because then people's equity will come down, because debt will remain where it is.
Yes, deflation always.
They don't know what to do. It's new territory. And they are trying to avoid a recession.
Because look, if you're looking at it from Powell's perspective, inflation isn't as bad as it used to be.
It is, if he does not say 3.
At least their own official metric.
Official metric is at 3.5.
Yeah, 3.5.
The core rate is also at 3.5.
That's not so bad compared to what they saw before.
Right, but you are still 105% above what you said. Then you say 2 is abandoned, 3 is the target.
But my point here is that your employment is strong. People aren't really...
Except that the market wants lower rates.
Yeah.
What is the reason to cut rates today? Your economy is growing.
Yes.
Your employment is full.
Yes.
Why do you cut rates?
But then the argument that Powell puts forward is that he's forward-looking rather than...
But you cannot guess the money. For a want of a better word, fool of yourself saying that inflation is transitionary. What is if you cut rates and inflation comes back again? You cut rates thinking you have licked inflation.
Yeah.
And inflation goes back to 4, then what do you look like?
Okay, but what happens if he keeps interest rates where it is today?
At worst case, you will have a short recession, then you cut fast.
And you should be fine.
Yeah. See, high BP can be reduced. Low BP cannot be boosted.
But the problem here is that in your C plus I plus...
They have in the C plus I, let consumption come to 0.
Yes, because he's not able to move in government expenditure because you have to support Ukraine.
Yeah, government expenditure is not only due to Ukraine.
Yeah.
There are other things. So... And you are supporting Israel.
Yeah.
That's unwanted.
That's unwanted.
Yeah. America has got it made. So if growth falters, he will do. But growth is also not faltering.
It's doing quite well.
So they were talking 4 rate cuts this year.
Yes.
And now they are talking 1 plus 6.
Yeah.
I don't think they'll get 1 plus 6. They'll be lucky to get 2 or 3 next year.
But as an investor, it seems like America is the place to be right now.
If you want, in dollar terms, investing, dollar companies are the place to be.
Because growth is resilient. You have currency appreciation, and it doesn't seem like Powell has much room to cut interest rates, like you said.
Exactly. So this is what it is. So let's see whether the market is right or the market is forced to bring a spread. If rates remain higher for 1 more year, then the spread has to emerge. Thank you for watching. Be Rich. I hope you like this presentation on bond markets. If you like the video, press the like button, turn on the bell notification, and subscribe to our channel. If possible, send this video to your friends and relatives and have them take a look. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written two books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.